Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by John Pattullo, manager of the Henderson Strategic Bond Fund. Hello, John.
Morning.
So, at the tail end of last year, you were one of the few people putting their head above the parapet and saying that inflation was not going to be a big problem, as many were predicting. In fact, we were entering into a deflationary environment, and you didn't get that too far wrong, did you?
No, I mean, Jenna and I have been of the view for years that the world, Europe, essentially is turning Japanese, as in low growth, low inflation, suppressed volatility and suppressed defaults. And that's exactly what has happened. The Trump thing confused investors, I think. We were fairly dismissive of it. We did a lot of reading and were frankly appalled actually by all the investment banks we read. Whatever model you put Trump in, good Trump, bad Trump, maverick Trump, whatever, most of them weren't talking a material change in growth or inflation, slightly to our surprise. Having said that, we were respectful of the Trump trade because we didn't know. I mean, you can't ultimately know. So we did shorten duration a little bit with a view to getting longer again because we didn't think that was a regime change. The other thing about the Trump trade was it was basically because China has reflated the world in early 2016. He got elected when the world was ticking up in a synchronized global economic activity, and he took all the credit for it, even though he hasn't really done anything. So all the equity managers sort of leapt on this, and obviously there was big rotation in equity markets for a while until year end of 2016. But 2017, it's actually the values, the growth stocks and tech have been performing, and bonds have been performing again. So we do feel pleased we called that correctly for our clients.
And the other thing that slightly confused matters were commodity prices, weren't they? The fact that oil doubled. Exactly. And many people said, well, this is it. This is inflation. New norms of 3-4%, double what, the bank is yes. recommending. And actually that hasn't come through.
Yes, and I think virtually all the street analysts had, 10-year Treasuries up at 3% or higher. And, some of the leading banks still have 4 or 5 US interest rate rises penciled in, and we think you get one this week. You might get one more. We think that's probably it. I think the equity community, if I could be so bold, some of them get a bit confused with headline inflation compared to core. So the oil price doubles, headline inflation goes up mathematically. Of course it does. The bond community is a little bit naughty because when the oil price halves, they all get a bit deflationist. Whereas if you look at underlying core CPI, it hasn't really done anything. So always look at core. Don't get distracted by what's going on in energy and oil. But you kind of felt the equity market, there's a reflation trade coming, I've been waiting forever, and here it is, it's fantastic, but it didn't actually last very long at all. And we think it's faded pretty fast.
So the first half of this year has certainly been that picture. Yeah. The question now, however, is what the next half of this year and indeed going into 2018, because well, with any call, you can only be right until you're wrong. Yes,
and markets are pretty much up with events. So even this time last year, the secular stagnation, Larry Summers' thesis got almost too mainstream. Everyone bought it. Bond yields were really low. US Treasuries were down at 1.3%. Then they doubled to 1.3 up to 2.6. Today they're 2.2. So yeah, is it in the price? Well, I think quite a lot of it is in the price. Having said that, everyone says, well, the 30-year bond market's going to end tomorrow and let's all sell bonds. It's all disaster.
Which they've been saying for about
forever.
10 years.
And all our clients are short of bonds. They're all short of duration, all of them, almost to a T, because we travel up and down the country. We've been in America traveling as well. And Jenna's got the same feedback from our American clients as well, slightly to our amazement. And a lot have gone into alternative products, peer-to-peer, infrastructure, lots of sort of fashionable stuff, which we've purposely avoided all that stuff. And it's a short duration asset class, so you haven't got the benefit of duration when risk is off. So I think quite a lot of it is in the price. What I'm just not convinced is just because the 30-year downtrend is long in the tooth, it doesn't mean you suddenly get a massive uptrend on the other side. Maybe a basis for the next 3 or 5 years. And bobs around a bit, you'll get a little bit of cyclical uptick, and bonds will sell off of it. And then you'll get the long-term structural demographics, digitalization, too much debt, all the stuff we've spoken about for years will reassert itself. As of today, I think Treasuries are kind of fair to cheap, but they have moved a bit. And the positioning's moved, so everyone was massively short when the economic data was just turning over, and obviously there was a short squeeze. Bond yields rallied, prices up, and as of today, I think there's a bit more in it actually. But we're not. You can't be more bullish when yields are at 220 than you were at 260.
John, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.